Are we unknowingly standing on the brink of a real estate catastrophe? Do you want to know the top 10 worst cities to buy a home in 2024 in America? In this video, we delve into the warning signs and unveil the top 10 cities where home values are expected to decline by up to 40% by 2030. According to Warren Buffett, a $1.4 trillion debt wave is about to collide with the housing market, causing prices to plummet. Let's get started. As the U.S. housing crash unfolds, particularly in the cities I'm about to unveil, it's crucial to understand the warning signs. These are the top 10 housing bubble cities in America where home values are expected to plummet by 2030, some even by 40%. Why am I confident in these predictions? Well, I've developed a model based on three key factors: median income, rental rates, and long-term home price trends. By combining these, I can provide a dynamic inflation-adjusted forecast for home values. Let's start with Atlanta at number 10. Home values here are projected to drop by 25%, from a typical price of $368,000 down to $275,000. The reason? Home buyers can no longer afford the soaring prices. For example, Zillow lists the typical home value in Atlanta as nearly 7 times higher than the average worker's annual earnings. The Atlanta housing market has been fueled by speculative activities and a surge in demand, leading to overvaluation. However, affordability becomes a significant concern as incomes fail to keep pace with the home price increases. The current market conditions indicate a correction is imminent, with home values expected to decline sharply in the coming years. Moving to Fort Myers, Florida, we see a similar story. The Cape Coral-Fort Myers area is forecasted to experience a 26% decline in home values. Like many parts of Florida, it's historically volatile, with dramatic ups and downs in home prices. Fort Myers has been a hotspot for real estate speculation, attracting investors looking to capitalize on rapid price appreciation. However, this has led to inflated home values that are unsustainable in the long run. With the market reaching a tipping point, a significant correction is on the horizon, and homeowners may face challenges in recouping their investments. Phoenix, Arizona comes in at number 8, with a projected 27% drop in home values. The current prices are significantly higher than the average local can afford, indicating an unsustainable market. Phoenix has experienced a real estate activity boom driven by population growth and job opportunities. However, this rapid expansion has led to inflated home prices, outpacing income growth and pushing affordability out of reach for many residents. As the market self-corrects to more sustainable levels, home values are expected to decline, posing challenges for homeowners and investors alike. Tampa, Florida takes the 7th spot with a predicted 27% decline. Speculative activities like flipping houses have inflated prices, but now we're seeing a surge in inventory as investors exit the market. Tampa's housing market has been characterized by speculative behavior, with investors driving up prices in search of quick profits. However, as market conditions shift and inventory levels rise, the outlook for home values becomes uncertain. A correction is inevitable, with prices expected to decline significantly in the near future. Charlotte, North Carolina, is our number 6 bubble, facing a 27% drop in home values. High levels of new construction combined with declining migration levels spell trouble for the market. Charlotte has experienced a period of rapid growth, attracting new residents and businesses to the area. However, this influx has led to an oversupply of housing inventory, putting downward pressure on home prices. Additionally, declining migration levels indicate a slowdown in demand, further exacerbating the situation. As a result, home values are expected to decrease. Raleigh, North Carolina comes in at number 5, with a projected 27% decline in home values. Home prices have surged beyond sustainable levels despite a steady influx of new residents. Raleigh has been a magnet for job seekers and businesses, driving population growth and economic prosperity. However, this rapid expansion has led to a shortage of affordable housing, pushing home prices to unprecedented highs. As the market adjusts to more balanced conditions, home values are expected to decline, posing challenges for homeowners and investors. Seattle, Washington is our number 4 bubble, facing a 28% drop in home values. Outbound migration has surged, signaling a downturn in the market. Seattle has long been a hotspot for tech companies and innovation, attracting a young and affluent population. However, recent trends indicate a shift in migration patterns, with more residents leaving the city than entering. This departure, combined with inflated home prices, suggests a correction is imminent, with home values expected to decline significantly in the near future. Salt Lake City, Utah takes the third spot, with a projected 28% decline in home values. Prices here make no sense compared to local incomes and rental rates. Salt Lake City has experienced rapid population growth and economic expansion in recent years, driving demand for housing. But this surge in demand has led to inflated home prices, outpacing income growth and pushing affordability out of reach for many residents. Home values are expected to dip when the market adjusts to more sustainable levels. Boise, Idaho is our second biggest bubble, expecting a 29% drop in home values. Negative growth in home values is already evident, and inventory is skyrocketing. Boise has seen a surge in population and housing demand, fueled by its affordable cost of living and outdoor recreational opportunities. However, this rapid growth has led to a shortage of housing inventory, driving up home prices beyond sustainable levels. Home values are expected to decline as the market cools and inventory levels rise. Finally, Austin, Texas tops our list with an expected 34% decline. Despite its reputation, current home values are vastly overvalued, and the market is ripe for a correction. Austin has been a magnet for tech companies and young professionals, driving demand for housing and economic growth. However, this surge in demand has led to inflated home prices, outpacing income growth and pushing affordability out of reach for many residents. With time, as the market corrects itself, home values are expected to decline significantly. In September 2023, Warren Buffett gave a serious heads up, seeing trouble brewing in the real estate world. Buffett cautioned, "We're facing a looming $1.4 trillion debt wave about to crash into the real estate market." He believes the real impact will hit in a few months. Buffett sees this as just the beginning of the fallout from years of easy finance, especially in the commercial real estate bubble. Charlie Munger, Berkshire Hathaway's vice chairman, noted that Berkshire has avoided commercial real estate, so he doesn't expect major effects on their company. However, he predicts significant and unpleasant changes, especially the decline of downtown areas, across the United States and elsewhere. "The buildings don't go away, but the owners do," Buffett remarked. Over the last 15 years, the real estate market has been fueled by massive amounts of cheap debt driven by historically low interest rates. For instance, if someone buys commercial real estate for $1 million, puts down $200,000, 20%, and borrows $800,000 from the bank at an annual interest rate of 5%, they'll pay $40,000 in interest to the bank in the first year. Whether the property can handle that debt depends on its net operating income, the rent it generates minus its operating expenses. Buffett highlighted that this reliance on cheap debt has inflated real estate values to unsustainable levels. The debt service coverage ratio, DSCR, measures a property's ability to service debt, calculated by dividing its rental income by its annual interest payment. Banks prefer a DSCR greater than 1.2. Commercial real estate is particularly sensitive to interest rate changes because many loans have variable rates. $1 trillion worth of commercial real estate loans is set to reset at higher rates, which could spell disaster for owners. If interest rates rise from 5% to 7.5%, a property's DSCR may fall below 1.2, making it financially unviable for the owner. In such cases, landlords may hand over their keys to the bank rather than bear the losses. Furthermore, economic downturns can lead to oversupply in commercial properties, driving down rents. The trend of remote work, accelerated by digitization, further undermines the demand for office space. Buffett emphasized, "We're seeing the consequences of people borrowing at 2.5%, hinting at the risks ahead." In commercial real estate, loans are often non-recourse, meaning the borrower isn't personally liable. If the property's value falls below the mortgage, the owner can walk away, leaving the bank to shoulder the loss. With a $1.4 trillion loan crisis looming, a severe credit crunch and recession, possibly even a depression, seem increasingly likely. Are you prepared for the real estate storm ahead? Let us know in the comments. If you enjoyed this video, you'll definitely love our other ones. Subscribe, like, and share with your friends.